Hey everybody, welcome back to thebusinesslounge.com. I'm Mo Al-Hamadi and I'm so excited about today's video because it's one of the first ones in this mini-series where we get into the nitty-gritty of investing as a whole. We're going to talk about how someone who's new to investing should go about it. Basically, investing 101. Now, like I said, this will be a part of a mini-series that I put up here on the channel, so make sure you guys don't miss it. So there are lots of different options out there for newbies, including Robo-Advisors or investment apps or a 401k plan, but it can be overwhelming just thinking of the different options that are out there. So where does one start? Well, the first thing I want to talk about is probably the biggest misconception about investing, is that it's reserved only for the elite or that you have to have a lot of money to start. This may have been true about 15 or 20 years ago, but not in 2020. All barriers to entry have been kicked down by technology and development in the sector. So with all these advancements, there's no excuse for beginners not to invest. So if you want to start building your wealth, stick with me to the end of this video for these tips and advice to help get you started on the right foot. Before we start though, have you subscribed to the channel yet? If not, you should do that so you don't miss out on the rest of the mini-series and any other videos I put out. Alright guys, let's do this. So we're going to start right out of the gate with the golden rule of investing. The rule states that you should never lose money. That's a pretty good rule, right? This rule was created by Warren Buffett, the investment guru who's amassed a huge fortune of wealth by applying that same rule. The best way to do this is by investing at attractive prices when that option is undervalued. When you do this, you're paying less than the real price, which can potentially earn you some serious cash down the line when things go back to normal. Now, I'm sure you've heard people say, there's no reward without risk, or you should always be willing to take risks, or risk taking is great. But you need to make sure that you're only taking calculated risks. I would suggest avoid short-term investing since it comes with higher risks. Instead, look for long-term investment options that have secure returns so you can minimize on risks. Warren Buffett built his wealth through long-term investing as opposed to short-term trading. Now, just to be clear, some people have made millions just through speculation, but an even larger number of people have lost money in the exact same way. Also, in short-term trading, there are multiple costs that are charged in fees and many uncertainties that could result in huge losses. Many other billionaires have acquired their wealth through long-term trading, just like Warren Buffett, because it's proven to be more essential over the years. Tip number 2 is to build a portfolio plan. Before you start, you need to define your goals and have a plan in place. Ask yourself these 3 questions. How much money do you want to make in the long run? Where would you like to be financially? And what would you desire your net worth to be? After you've asked yourself these questions, you need to put a plan in place for you to get there. Once that's done, you need to decide or identify which investment options are most lucrative and whose return would give you the earnings you wish to have within those given timelines. Use this as your guide when making your investment decisions. Number 3 is paper trading. As someone who's new to investing, paper trading lets you gain real experience without having to risk any real money. With this technique, you're allowed to trade and invest in stocks, track profits or losses, and pretty much do everything else you would have done in reality. Today, there's so many platforms out there that allow you to practice and hone your skills at no cost at all. Think of it as an investing playground before you invest with your real money. I personally think everyone starting out should begin here because what do you have to lose? The other option is to risk your money in real life while you learn the basics along the way. Number 4 is stocks. As a beginner, buying stocks of a single company can be one of the best ways to invest your money. When you invest in the right company, you could earn as much as 15% a year. This same strategy that I'm about to show you is the same one that Warren Buffett used to take advantage of the market for the last 60 years. So how does a beginner investor know where and when to invest their money? The most important thing to keep in mind is choosing the right company at the right time. To do this, you have to do some serious research into the company you're thinking of. Look at their past performance, their management, their financial reports, and the moat. Once you've identified a company that meets your qualifications, don't invest in it right away. Put that company on your watch list for a period of time. While you wait, just keep an eye out for any price dips. Once you see that price go down, then you should buy. You'll get a great bargain and profit once the company goes back to its real value. One thing you have to absolutely remember is to keep your emotions in check. You should understand that markets are very volatile and that even the best companies might experience dips every once in a while. Don't panic or make hasty decisions based off of any drastic changes. Instead, wait and be patient enough to analyze the situation first. Then, make your decision. One thing to avoid though at all costs are penny stocks. These are stocks of companies that are valued under $5 and so they obviously seem pretty attractive to buy. But you need to know that these are really volatile and usually there's very little information to find on them. Most penny stocks are for companies that are pretty new in the public eye, so staying away from them until they prove their worth is probably your safest bet. Number 5 is using investing apps. If it wasn't for technology and its advancements, I have no clue where we'd be. In terms of investing, technology has made it so easy for beginners because there's tons of investing apps out there that are specifically tailored for them. Some of them even round up your purchases on credit card and debit card purchases and invest them for you in a portfolio of ETFs, which I think is a pretty genius idea. These apps will work like Robo-Advisors that will actually manage your portfolio for you. If you still want to do it by yourself, there are a bunch of other apps out there that will train and teach you how to invest. Most of them charge really small fees and are pretty convenient since you can access them at any time and on any device. Next are ETFs. ETFs are exchange-traded funds and are pretty similar to index funds. They also track a specific market index and use the same investing approach. These funds also tend to have less fees compared to mutual funds. The main difference between the two is that rather than having a minimum investment, the ETFs are traded throughout the day and have a share price that fluctuates. This share price is the ETF's minimum investment amount, which can be less than $100 or sometimes even more than $300. Since they're traded daily like stock, they also incur brokerage fees that are paid in commissions. Lots of people have made a lot of money through them, but they require extensive research and you have to be quite vigilant. To really succeed with them, you're going to need to dedicate quite a bit of time though, or pretty much be a full-time investor. Alright, moving on. Number 7 are index funds. Probably the easiest way to explain index funds is mutual funds on autopilot or cruise control. It's a great alternative to hiring a portfolio manager to create one for you. An index fund will track a specific index for you. What is an index? A market index is basically a collection of investments that represent a segment of the total market. A good example would be the S&P 500, which holds the stocks of 500 of the biggest companies in America. The S&P 500 fund will mirror the performance of the companies that are within that category and buy their stocks. The expenses are lower since the funds take a passive approach to investing. They're tracking the overall market index rather than having a real professional portfolio manager. Now, just like mutual funds, if you invest in index funds, you'll be purchasing a chunk of the whole market in a single transaction. You'll find that in many cases, index funds have minimum investment amounts, but a couple of brokerage funds have no requirements. That's pretty amazing, right? This investment option is the better one in the long run. Number 8 is target date mutual funds. These are similar to retirement plans. This investment option will automatically invest money with the estimated retirement year in mind. A mutual fund is basically a basket of many different investments where an investor buys a share in the fund, and that way he or she is investing in the total holdings of the fund. All of these funds are run by professional managers who choose how the fund will be invested, but generally speaking, each fund has a specified theme to it. So for example, an equity fund will invest in stocks. In most cases, you'll find the targeted mutual fund holding a mix of bonds and stocks. If you plan to retire in 20 years from now, you can select a mutual fund of your preference and it'll be labeled 2040. When the term ends, that's when you begin to enjoy the fruits of that investment. In number 9, we're talking about Robo-Advisors. Now, just as the name suggests, these are robots that offer financial services like building portfolios or selecting investment options on people's behalf. If you don't know much about investing, Robo-Advisors are a great option because they'll manage all of your investments by using computer algorithms. These systems generally incur lower overhead costs, and so the fees to operate are relatively lower than they would be if you were to hire brokers to manage your account. It will cost you anywhere between 0.25% and 0.5% to use a robo-advisor, and between 0.5% to 5% to hire a professional financial advisor. When you're still a newbie and don't have a lot of money on hand, this is really an easy way out. Now, I'm not saying let them do all of the work. You still have to monitor where your money is going and what's happening with it. If you find this interesting and you want to learn more, some advisors have educational content and useful tools that'll help you better understand the processes that are involved. It really is cheaper and a more convenient and proven way to invest. The last point in this video is employment retirement plans, or 401ks. A retirement plan is probably the best place to start, really, as a rookie investor. Some companies will actually match your contribution. So let's say, for example, you contribute 2% of your salary, your company could contribute another 2% equal to that amount that you put into the plan. I know it might seem like a small amount, but remember guys, it's free money and it will grow over the years. Today, you can contribute up to $19,500 in your 401k and $26,000 if you're above the age of 50, or at least that's the case in the US. The beauty about this investment is that there's no minimum deposit required. You can start with as little as you can afford to. When you choose a plan, the amount will be automatically deducted from your account. And get this, most retirement plans are made pre-tax, so that means you actually end up saving a lot more money in the long run. The power of compounding also plays a huge role here in growing your money. A little contribution every month can turn into quite a bit of money over the years through compounding. The bottom line is, folks, if you follow this short guide to investing, I'm pretty sure you'll be all right. So that's it for today, and I hope you enjoyed this video. If you did, please give it a huge thumbs up and make sure you smash that subscribe button if you haven't done it yet. Also, make sure you turn on your notifications so you can be one of the first to know when we come out with a new video. Remember guys, this video is part of a mini-series we're doing for you on all things investing, so make sure you tune in to the next one. I'd love to hear your thoughts and comments on today's video. Which of these options is the one that you'll start your investment journey with? Please share it with me in the comment section below because I would love to know which option sounds the best for you. Alright, until the next one, I wish you guys all the best and I'll see you soon. Bye bye.